Hi, I'm Joel, Director of Capitalised Business Finance. In this video, I'm going to be talking about supplier finance. What is it? How does it help a business manage cash flows and working capital? And what are some of the advantages of using supplier finance? But firstly, just to let you know who I am, I'm an independent business financier who's helped many businesses achieve complete cash flow control through tailor-made financing solutions such as selective invoice finance, supply chain and trade finance, import finance and short-term business loans. Over the years, I've learnt a lot and seen many businesses make mistakes that have cost their businesses dearly. Mistakes that can be avoided by some basic understanding of how this industry works and what to look for when searching for a business financing facility. One of my goals is to provide the knowledge to empower other business owners to achieve success. The more positive, motivated, happy and successful business owners we have in our society, the better our lives will be. I'm also a property developer and investor, and I'm passionate about helping good, honest people succeed. I don't come from privilege. My parents came to our country with one suitcase of clothes and couldn't speak English. I'm self-made, and from personal experience, I'm a firm believer that everyone has the opportunity to be whoever they commit to be, but they must commit and put in the effort to succeed. So, let's talk about supplier finance. Supplier finance is a general term that describes a business financing facility where a business engages a third-party financier to make payments to their suppliers on their behalf, then allowing the client to extend payment terms back to the financier. It's a way to delay your payments to suppliers, but guaranteeing that suppliers are either paid on time or paid early. It can be a useful cash flow management tool in circumstances where your own customers may pay on long extended terms or your customer payments vary, but you need to ensure that your suppliers are paid on time. Take, for example, a large business in the construction or manufacturing industries, or perhaps a head contractor in earth moving. These businesses often have many subcontractors working for them, and in order to maintain a working relationship with their subcontractors, they need to make payments on time every time. It's common practice for subcontractors to withhold supply or service when payments are slow and late. As such, having a facility to ensure subcontractors are paid on time ensures continuity of supply for your business. You want to be the customer of choice by your suppliers, not your competitors. By being able to manage when you repay the financier, you can effectively manage cash flow gaps in your business without burdening your suppliers with cash flow problems themselves, putting your supply chain at risk. But hold on, I hear you say. You can solve cash flow problems with an invoice finance facility. Yes, you can, provided that your customers are also businesses. If your customers are private consumers, then debtor financing isn't an option for you. Because supplier finance operates on your accounts payable side, you can have any type of customers. As long as your suppliers are also businesses, supplier finance could work for you. In addition to this point of difference, there are other differences between debtor finance and supplier finance that could mean that a supplier finance facility is a better option for your business. I'll talk about these shortly, but firstly, let's get a clear understanding of how supplier finance works. Debtor finance converts a business's accounts receivables into cash through a buy-sell agreement with a financier, where the financier buys the client's debtor invoices. If you haven't seen my videos on how invoice finance works, be sure to check them out on the Capitalised Business Finance website. Supplier finance doesn't add cash to the client business like debtor finance does. Rather, it delays the spending of cash from a business, allowing the business to reinvest that cash elsewhere in the meantime. In simple terms, the financier pays out the supplier and assumes the supplier's position in the client's accounts payables ledger, albeit with a longer payment term and a slightly higher payment amount, which constitutes the fee. Ideally, the client repays the financier when the client's own customers have paid, resulting in the client being able to run their business without needing any of their own capital to pay their supply chain. The cash that's no longer locked in the client's supply chain can be redeployed into other areas of the business, such as marketing, diversification, stock, essentially into growing the business. When the value of growth is larger than the cost of finance, it makes absolute sense to utilize these types of facilities in your business. Let's look at some of the advantages of using supplier finance keeping in mind that there are many variations in the marketplace. So these advantages are general, and I urge you to look closely at all of your financing options to find the best fit for your business. One advantage is the cost of the funds compared to debtor finance. Debtor finance and supplier finance are priced similarly, but where debtor finance advances you around 80 to 90% of your debtor invoice value and you're charged on the full face value, supplier finance provides for 100% of the value of the supplier invoices. For the actual amount of cash your business receives, supplier finance can be a more cost-effective option. Another advantage is that when a client business utilizes a supplier finance facility, the supplier businesses automatically receive a cash flow solution for their businesses. The same pricing advantage applies to the supplier business when compared to the pricing for debtor finance. That is, the supplier has access to up to 100% of their invoice values with supplier finance, not 80 or 90% as with debtor finance, meaning that supplier finance is a more cost-effective solution for supplier businesses than debtor finance. Yet another advantage is that some supplier finance facilities can provide a rebate to the client business in certain circumstances. I've mentioned that suppliers can be paid early, before the original due date of the invoice. Having the ability to take early payment is a huge advantage to many businesses, and I'll talk about this soon. But for now, if the supplier takes early payment for their invoices, the supplier will settle for a small discount on the invoice value. With some facilities, if the supplier takes early payment, the financier will share the discount with the client, effectively reducing the cost of supply to the client business. It is this feature of supplier finance that provides an opportunity for a business to convert their accounts payables from a liability into an asset, a revenue stream. One of the major advantages of supplier finance, often not considered by businesses which do not have a cash flow or working capital problem, is the positive strengthening impact it can have on the supply chain. Supplier finance can act as a form of insurance for your business, improving your business's resilience, ensuring continuity of supply. For businesses with a handful of key critical suppliers, supplier finance can have two impacts. One, by making sure those key critical suppliers are financially supported by an automatic cash flow solution, the supplier's businesses is less likely to fail from cash flow problems. Remember, 40% of Australian businesses fail due to poor cash flow management. By keeping your suppliers financially supported, you are ensuring continuity of supply and continued support for your own business. 2. When you utilize a supplier finance facility, you are guaranteeing that your suppliers are paid on time or early. So in situations where, for example, your supplier may have low stock or they need an automatic cash flow solution that you provide them, when your supplier is faced with a decision on who to provide supply to, your business will be their preferred customer. Nobody wants to be that business which has a bad reputation for delaying or not paying their suppliers, not only from a preferred customer point of view, but perhaps more importantly, from a preferred client point of view by a financier or an insurer. How you treat your suppliers and customers is often a reflection of your capabilities and your character, and it should come as no surprise to you that it's publicly available information. Your reputation as a good, reliable business person is a major consideration when financiers and insurers are deciding whether or not to accept you as a client. Whenever you apply for finance, your financier brings funds to the table, while you bring your history and the promise of future performance. The financier will decide whether your history warrants taking you on as a client, so you want to ensure that your history is as good as possible. By utilizing a supplier finance facility, you shouldn't have a history of payment demands or court actions arising from late creditor payments. Your credit history is likely to be stronger. A better history generally means that you could access better quality finance and insurance solutions to further grow your business. I've spoken quite generally about what supplier finance is, how it works, and some of the benefits of utilizing supplier finance as a form of business finance. As with other unregulated financing products, there are many providers and variations of products available on the market. The key, as with all finance, is to find one that fits your business. With features such as secured versus unsecured, supplier payment flexibility, and rebate rates as variations between the facilities, finding the right solution for your business can mean the difference between mediocre benefits and outstanding benefits. So be sure to check out my other posts where I discuss some of the variations and what they mean for you and your suppliers. Thank you.